The best performing giant in tech this year isn't the one building the most AI. It's the one refusing to spend like the others. Grab your espresso. Let's talk about spending. Every tech giant is pouring tens of billions a year into AI. That money used to come back to shareholders. Now it goes into concrete. It's called capital expenditure, not salaries or ads. Money spent building things, data centers, chips, and the power to run them. Together, the biggest companies are committing hundreds of billions, the largest private construction boom of our lifetime. And increasingly, it isn't spare cash. It's borrowed. Debt is piling onto balance sheets that were famously debt-free. Which brings up an old rule. In every gold rush, someone sells the shovels. Remember that? So why spend at all? Fear. No board wants to be the one that missed the most important technology in decades. Fear is a wonderful salesman. For a while, it worked. Every giant spending announcement was cheered. Bigger number, bigger commitment, higher stock price. Then the questions started. Simple ones. Where is the revenue? When does this pay for itself? Because a company isn't worth what it spends. It's worth the cash it can eventually hand back to its owners. And here's what everyone gets wrong. In an arms race, spending doesn't win. It just stops you from losing. If every rival builds the same data centers, nobody gains an advantage. Everyone runs faster and stays exactly in place. The reliable profits go somewhere else entirely, to whoever sells the chips, the power, the concrete. The supplier gets paid either way. We've watched this film. Late 90s, telecoms borrowed fortunes to lay fiber optic cable across the world. They laid far more than anyone needed. Capacity outran demand. Giants went bankrupt. The cable stayed in the ground, and someone else bought it later for pennies. The infrastructure was real. The technology was real. The investors were still wiped out. Being right about the future isn't enough, which is why the market's mood flipped. Same industry, opposite reward, praise for one company building furiously, praise for another for holding back. The technology didn't change. The question did. From how much are you spending to what are you getting back? Because spending only creates value if what comes back beats what it cost to borrow. And meanwhile, the shovel sellers have already been paid. So what does the capybara take from this? 1. A company is worth the cash it keeps, not the cash it burns. 2. In any gold rush, ask who gets paid no matter who wins. Spending is not strategy. Stay patient. Stay calm. If Cap changed how you read a capex headline, subscribe. One brutal market truth at a time. And no, not financial advice. Cap is a capybara.